All right, everyone, we finally made it to level 4 in the 5 levels of investing series, and we're ready to start investing. If you followed the series so far, you know that the prior levels were to set up a foundation for our wealth so that we could build it faster and more efficiently. In level 0, we conquered our debt. In level 1, we reframed how we think about cash. In level 2, we avoided the trap of financial advisors. And in level 3, we opened up tax-free accounts to minimize the amount of tax we pay to the government. And now we are ready to start investing our hard-earned money. And it's at this point in our journey where many of us can be led astray because there are an infinite number of ways to invest our money. There's stocks, there's bonds, there's Bitcoin, there's crypto, there's real estate, there's commodities, there's my uncle has this business that he's starting. There are so many ways we can invest our money. If you've ever played the video game Breath of the Wild, it's like that very first scene when Link wakes up from his slumber, walks out into the open world, and you see this infinite world of possibilities before you. It's incredible, it's beautiful, it's awe-inspiring, but it's also kind of overwhelming for a first-time player. This is the exact position we are in our financial journeys. And so today we are going to cover the decision that lays before you, which is passive investing versus active investing. We're going to talk about why active investing is so tempting, why it's dangerous, and why passive investing is the way to build your wealth. So without further ado, let's dive in. What's up, everyone? This is Brandon, and welcome back to Wealth Potion. If you're new to the channel, this is where you learn about finance, the economy, how to start a business in a fun, simple, and easy way. And I love using video game analogies because let's face it, a lot of us grew up playing video games, and building your wealth or building a business is kind of like a giant real-world video game. And as mentioned, today we're talking about the distinction between active investing and passive investing. To put it in really simple terms, active investing is where you're making decisions, maybe every day, every week, every month, to manage your investment portfolio, whereas passive investing is where you take a hands-off approach. You invest your money and then you leave it. And when you're starting out as an investor, it can be very, very tempting to be an active investor. And there's a lot of reasons for this. I know this because that's what I did. When I first started investing 10 plus years ago, I fell in the active investing trap. So first, let's dive into what makes active investing so tempting. And I'm going to explain it to you by sharing 5 cognitive biases, or debuffs, if you will, that we all experience as human beings that leads us to think that we can beat the market. Then we're going to look at the data, and I will show you why, mathematically speaking, passive investing is the better option. And before I dive into these cognitive biases, I am fully aware that many of you watching this video are going to watch this video, you're going to hear all the rational, psychological reasons why active investing is terrible, and you're going to hear all the mathematical reasons why passive investing is better, and then you're still going to actively invest. That's the human brain. It's just how it works. Hopefully I convince some of you to stay away from active investing, but I also want to recognize that many of you will still actively invest, and that's totally fine. But I hope a year from now, or 5 years from now, or even 10 years from now, you remember this video where I told you that active investing comes with a lot of risks, and our brain plays these tricks on us to make us think that we're a better investor than we actually are. So what are those cognitive biases? What are these debuffs, if you will? The first one is pretty straightforward, and it's the potential for higher returns. When you look at the S&P 500 and you see that it returns 10% per year on average, it's very easy to look at that and think 10% isn't that high. And it's because our brain is not trained to think in the terms of what 10% means over 10 years, 20 years, 30 years, 40 years. If you have $1,000 to invest and a year from now you're going to get $100, you might simply think, that doesn't sound like a lot of money. And meanwhile, there's Bitcoin and meme coins and Dogecoin and Fartcoin, and they're making hundreds and thousands of percent on their money. What we'll cover in a moment is how it's not the 10% in a single year that matters, it's 10% over decades that is extremely difficult. The next cognitive bias is one that I experienced personally myself, and I think a lot of you will likely experience in this very moment, which is called the Dunning-Kruger effect. The reason for this is that at the time in our life when we start investing our money is oftentimes also the time in our life where we're getting really good at our job. And when you build competence in something, you also build confidence. The problem is that this confidence can spill out into other areas. You've seen this in action. If you watch any podcast with rich and successful people that really killed it in a single domain, they often will start talking about other domains as if they know it all. That is the Dunning-Kruger effect in action, and it affects everybody, not just the extremely rich and wealthy. And like I said, this is exactly what I remember thinking when I started my investing journey. I just started a job at a really hot tech startup. I was doing high ticket sales, so I was making good money, and I thought, this investing thing, how hard could it be? That is a trap. The third bias on the list is hindsight bias. It's very easy to look at the stock market today and look at Nvidia or Tesla and think, oh, well, this is such an obvious bet. Nvidia is the most important economy for the AI-enabled future. That's such an obvious investment. But what we often don't recognize is that 5 years ago, 10 years ago, when Nvidia's stock price was much lower, that is not what people thought. And that's why the stock price rose. And in fact, it probably would have been very unpopular to invest in Nvidia at that time. And this is related to the fourth cognitive bias. The fourth cognitive bias is selective memory. If you think back to your childhood, I bet you are more able to recall positive memories than negative ones. And this is a very real psychological phenomenon that happens in our brains where we remember the good things and we forget the bad things. And when applied to investing, can be very dangerous, because you will often think of yourself as a better investor than maybe you actually were. And last but not least, also related to our memory, is self-serving bias. In other words, when something good happens to us, we're much more likely to attribute that success to our own behavior and our own actions. Whereas when something bad happens to us, we're much more likely to attribute it to external factors. So to use an example from investing, if you pick 5 stocks today and in 10 years, one of those stocks did really, really well and the other 4 did poorly, not only are you more likely to remember the one stock that did well, but you will also think that that stock was such a genius pick by you. But those other 4 stocks, well, the economy was bad, or it was unlucky, or the Fed didn't lower rates, or it was someone else's fault. So those are the 5 cognitive biases that I think are most powerful. There are probably more, by the way. This just goes to show that our human brains often trick ourselves into thinking we're better at something when maybe we're not. And this especially applies in investing. And so like I said earlier, if you watch this entire video, you recognize all of those biases and you still start active investing, that's totally fine. I made this mistake. Many of my friends and people that I know have made this mistake. Just remember these things so that you eventually walk away from the dark side. All right, so we've covered why active investing is so tempting, but why is it bad? Like, why is it a worse option than passive investing? This one is really simple because all we have to do is look at the data and the numbers. As the old saying goes, people lie, numbers don't lie. And when we look towards Wall Street and we look at the average hedge fund between the years 2010 and 2020, so 10 years, the average hedge fund was not able to beat the S&P 500 index. These are people that have spent their entire lives, their entire careers studying finance, learning how to invest other people's money, and even they can't beat the S&P 500 on average. So if you think you can beat the S&P 500 with your limited experience, and while you have a full-time job doing something completely unrelated to finance, well, I wish you the best of luck. And here's the dangerous thing too, related to those biases, is that oftentimes you pick a stock and then over the course of a year or two, it goes up and you were right. You made a great solid investment, and that just encourages you to continue active investing. The hard part is not outperforming the S&P 500 for a year or two. The hard part is outperforming the market year after year after year, decade after decade after decade. Think of it this way. If you pursue the path of active investing, you'll need to actively invest for 10, 20, 30, 40 years. So on top of your day job, you also need to be your own hedge fund manager, and you need to be better than the hedge fund managers on Wall Street. By the way, there are many other graphs like this one where if you just look at the numbers, it will clearly show you that passive investing is the way to go. In case the numbers aren't convincing enough, I'll share with you 3 of the more qualitative reasons why passive investing is so powerful and beats active investing. And the first one we just kind of touched on, which is that passive investing is by definition hands off. It's passive, whereas active management requires active monitoring and managing of your portfolio over time, which performance aside, it's just going to take up a lot of your time, energy, and stress. The second reason is that it's easy and simple. As we'll cover in a moment, all you have to do is download an app on your phone, submit some paperwork, and then buy an index ETF or set up a recurring buy on an index ETF, and you're golden. You could uninstall the app and leave it for 10, 20, 30, 40 years. In fact, you'll probably do better than the people that kept the app installed. And last but not least, this is more specific to index ETF investing, but one of the benefits of a passive investing strategy is that it's well diversified. By owning the entire S&P 500 index via an ETF, you are spreading your risk around 500 different companies. So if Tesla becomes a political firebrand because of the actions of its CEO, you aren't fully invested in Tesla. You have your money spread around a lot of companies, and the actions of one man won't impact your investments as much. Now, as a little teaser, we are going to cover in level 5 what I think is the ultimate investment strategy that blows all of the other strategies out of the water, which is a passive investing strategy, but does not use an index ETF. We're going to cover that in the next video in this series, so if you'd like to see that, subscribe to Wealth Potion, and I'll see you there. In short, those are the 3 main reasons that passive investing often outperforms active investing. It's hands-off, it's simple and easy, and it's well diversified. There's a lot more that I can dive into with regards to the differences between passive and active investing. If there's interest in this, or if you remain unconvinced that passive investing is the way to go, leave a comment. I love the discourse that you guys start in the YouTube comments. I love chatting with you guys and making it a two-way conversation. So let's keep that going, and let me know if you have any questions or thoughts on this approach. And if you're tempted to actively invest, I'd love to hear why. So let me know. Now, if you are convinced that passive investing is the way to go, you probably want to know how to get started. So we're going to flesh this out right now. The first thing you need to do is open up a brokerage account. This can be on a platform like Wealthsimple in Canada or Robinhood in the United States, or if you have a bank account, the vast majority of banks also have a way to open up a brokerage account to trade stocks or equities. Now, hopefully you've already done this because you watched level 3 in this series, and not only did you open any brokerage account, you opened up a tax-free account, so something like a TFSA in Canada or a Roth 401k in the United States. But even if you didn't do that, even if you just opened a regular brokerage account, we can get started. The next thing you want to do, assuming that the bank or financial institution has approved your account, you've maybe submitted a copy of your ID, what you want to do next is deposit cash. Deposit some money into this brokerage account. You can think of it kind of similar to your bank account. You're moving money from one bank account to another account, except this one can actually hold stocks and equities and other financial instruments. The next thing we're going to do is we're going to choose an index ETF. To keep this step really simple so you don't have to research index ETFs, because there are different kinds, we've been talking a lot about the S&P 500, so you can use an index ETF like VOO, which is Vanguard's S&P 500 index ETF. It literally tracks the S&P 500. But if you really want to get into it, you can look into other types of index ETFs that track the entire stock market, or just the US stock market, or just emerging markets. The idea behind an index ETF is that it tracks an index, which is a bucket of a lot of stocks. Step 4 is you buy shares of that index ETF. You could do this in a lump sum. So if you deposited $1,000, you could put all of that money into the index ETF, or you can do something called dollar cost averaging, where you purchase a little bit at a time, maybe $100 every day or $500 every week. And many apps and brokerages will allow you to set up recurring buys. So it's literally passive, it's literally automatic. And in fact, many of the platforms will also allow you to do automatic deposits of money. So they can literally take money out of your bank account, put it into your brokerage account, and then buy that index ETF over and over again over the course of weeks. And then the last step is to wait. You are literally done. That is all you have to do. And by the way, I know that that sounds so simple that I remember when I first started investing, I remember making my first purchase of an index ETF and thinking, is that it? Like, am I actually done? And it really is that simple. This is because a lot of people have this idea that investing is this complex, arcane thing that's exclusive for Wall Street, but it really is super simple when you get started. So don't be worried when you make that first purchase. Now all you have to do is wait. By the way, I've been getting a lot of questions from followers and friends of mine around this idea of dollar cost averaging. So stay tuned for that. We will also be doing another video all about dollar cost averaging and why it's so important. But in short, if you really want to know the one sentence summary, it's because it completely removes the human emotional element between buying and selling stocks. A passive investment strategy works because it's passive. And if you have to log in every week to stick to your system of buying that index ETF, and there's a huge emergency on the news like Trump announcing these massive tariffs, you might log into your app and think, you know what, maybe I shouldn't buy this week. Maybe I'll skip this week because the stock market might crash. And before you know it, you're now active investing. So dollar cost averaging is incredibly important. We will be doing a deep dive video on that in the future, but that's basically it. I hope that you all internalize this, especially those cognitive biases. I've said it multiple times, but if you do decide to go active investing, don't beat yourself up over it, but just remember at the back of your mind that you could be making more money and you could be way less stressed if you just follow passive investing. As always, thank you everyone for watching all the way through. If you're at this point in the video, I really appreciate you truly, and I will see you next time.